All right, so I'm jumping into some additional issues when it comes to our inventory. This is going to be, this lecture is going to focus on lower of cost or net realizable value, and then there's going to be some subsequent ones that look at lower of cost or market, and then the gross profit method, the retail method, and so a lot more detailed topics. These are definitely intermediate topics that you're gonna, sort of probably haven't talked about in principles. And so we'll try to move slowly, but not too painfully slow throughout each of these topics. And so again, this is, really for the way I organize the class. It's the second chapter, basically the more detailed chapter on LIFO, or sorry, on inventory. And so when we look at subsequent measurement, there's basically things happen after you acquire your inventory. Your inventory can get damaged. There can be physical deterioration. There can be obsolescence, changes in prices, or, a lot of things could affect unsold inventory. And so, under GAAP, normally you carry inventory based on cost, but you can depart from that through what's called an inventory write-down. And essentially, if something other than cost is a lower value than what cost is under certain circumstances, you would write that inventory down. And so you basically would go against the traditional view of or traditional treatment of historic costs for inventory and measure it some other way. So there are two approaches that we generally use when we're going to potentially depart from using that cost. One is called lower of cost or net realizable value. You apply that method when you're using FIFO, average cost, basically any method other than LIFO and the retail inventory method. The other method is lower of cost or market, and that's the approach that you use with LIFO and or the retail inventory method. So those will be covered in a different lecture. All right, so what happens? So whenever we have a write-down, what actually happens? Well, first of all, you do reduce what you report as your inventory. So the carrying value of your inventory is less. So just to be very clear, we don't mark inventory up using these approaches. We would only mark them down. So you would report, if you actually apply this, you would end up having to report reduced inventory. There would be a loss. So when you write down that inventory, there are really kind of two ways that loss could show up. One would be, and this is the way we're going to kind of do it, one is just increased cost of goods sold based on that loss. And another one is sometimes you might separately track that inventory write down. And a lot of times if you have that separate or separated out, it could be as a separate item in cost of goods sold, or it could be as like a non-operating item. All right, so lower cost of net realizable value. Again, we use this approach when we're using a method other than LIFO or retail inventory. And what is that? Well, this net realizable value, the first thing you do is you estimate the selling price. Obviously, you haven't sold these items. They're in your inventory, but you're going to estimate basically, hey, listen, if we go through a normal process, this is what we would sell them for. And then we would subtract. Now, I want to be very clear. If they're damaged, I mean, it's whatever you could sell them for in their state. So it's not in their perfect state, it's in their current state. I should have clarified that. Then from there, you would have to subtract any reasonable estimation or subtract a reasonable estimation of costs to completion, disposal, transportation. In other words, even whatever state they're in, there might be something else you need to do to those inventory items before they can be sold. And so you need to subtract that cost off. And then that net difference, that is the net realizable value. Again, the expected selling price in their current condition based on the normal process, subtracting off the costs you're going to incur to prepare it for sale, and that difference is the net realizable value. All right, so if the net realizable value is lower than the current carrying cost, then you have to adjust it, you have to write it down. If it's more, no adjustment is necessary. So how do we apply this? You can apply them to individual inventory items, which is kind of the most common. You could also apply it to major categories of inventory, or you could apply it to inventory as a whole. Any one of those three is acceptable. All right, so here's an example. Lots of information here. Really, the only thing I want to kind of focus on, because the rest of this is in the next table, is this 15%. Basically, it's saying, hey, to get these items ready for sale, about 15% of the selling price is going to end up being kind of consumed in extra costs. That's really the only piece of this that you really need. And so here's a bunch of different information. So you've got, several different products, different quantities of each, and then this is the unit cost. This is the current cost of that unit, and then this is the current selling price. And so again, this is whatever state they're in. This is what we estimate we'd be able to sell those items for. And so we want to get, and just again, a reminder of that 15%. If we want to get a total cost, we take the quantity multiplied by the unit cost, and that gets us our total cost for each of these items, just kind of filling out the table. If we want a total selling price, we take the quantity, multiply it by the selling price, and that gets us our total selling price. Again, so we have a total cost, and we have a total selling price because we're going to apply lower of cost or net realizable value, not on a per unit basis, but on a total basis. And so we're going to kind of introduce a more expanded chart. So now what we've done is we've taken the 3 different 100 items, and we've sort of created one group, and we have another group of those 200s, and then of course we have the total. And then what we're doing, and if you kind of think about, we can either compare at the individual level here, we can compare at the category or group level here, or we can do total inventory here. So this is just our point of comparison. The 2 measures that we're comparing really are these 2 columns, the cost column and the net realizable value column. The cost column is pretty easy. We're just taking the total cost from up here, and we are just transferring it down here. And so we're just taking each individual item's cost, and we're just bringing the information from this table down to this table. And then what we can do is obviously we can subtotal up. So this is, the full group 1 cost. This is the full group 2 cost. And then this is the total cost of all the inventory together. And then for the net realizable value, again, we're going to take that total selling price, and we need to subtract that 15% cost to get it ready to sell. So really, the net realizable value is 85% of this total selling price. Again, we're subtracting off the 15% of additional costs. And so we take that selling price, we multiply it by 85% because that's the net. So 5,980 times 85% is 5,083. And we do that with every single item. And so those are the individual items. Again, we similarly add things up to get group subtotals and then a total inventory amount altogether. And so then what we do for each of these, we choose the lower of cost or net realizable value. So first, looking at the individual items, we would compare item by item. So we'd look at the cost of items 100-1 and compare it to the net realizable value. And in this case, the net realizable value is the lower number. And so that is what we bring over into this column. We do something similar for the next one. In this case, you can see the cost is lower than the net realizable value. So we would carry over the cost. And we would do that with every single item here. Once we have every single one of those items, we add them up. And now we have a total of the lower of cost or net realizable value. And one thing to kind of note here, if at any time you use the net realizable value, you will have an adjustment, right? So on an individual basis, if we have some net realizable value number that we're using, there is going to be a journal entry. There's going to be an adjustment that's necessary, and we need to quantify that. And so we compare the cost that we're carrying it at now with the net realizable value that we just calculated. Again, we took the lower of the 2, the lower of the cost or net realizable value, and we added all these up. And so when we go to our journal entry, we can see that the current cost is $50,255. The lower of cost or net realizable value amount is $49,754. And so that difference is the adjusting entry, or $501. The adjustment goes to our inventory account. Now, realistically, that would be itemized by inventory item. We're just kind of aggregating it all together. But what you can see is that we're reducing our inventory down to 501, or by 501 down to the 49,754, and that we're just going to offset with an increase to cost of goods sold. As I mentioned before, you could have like an inventory write-down account, which would be a different kind of expense account, but we're just going to write it off to cost of goods sold. And so that would be the journal entry. All right. The next level of comparison would be by group. So in that case, we would be comparing the cost of group 1 to the net realizable value of group one, and the cost of group two to the net realizable value of group two. So we are ignoring individual items. Instead, we're just comparing groups. And so when we look at this group, the cost is the lower number. And we look at this group, the net realizable value is the lower number. And so we would carry over the cost and we'd carry over the net realizable value, and that is the lower of cost or net realizable value at the group level. We add that up, and again, similarly, we make a comparison to that total, which is our lower of cost or net realizable value total, and we're comparing that to the cost. And of course, you can see there's a difference. And since there's a difference, there will be a journal entry. In this case, of course, that journal entry is $170 based on that difference on the previous slide, based on this difference right here. I think my math's off. Sorry. This number should be slightly different, I think. I don't know. We'll figure that out. But anyways, whatever that difference is, yeah, I know, because this should be 2045. Sorry, this should be $50,045. I need to fix that. But all that to say, the entry amount would be $170. And so the entry amount then is, again, we decrease our inventory by 170, and that goes as an increase to our cost of goods sold. That's how we would close that out. Again, I think I did some math on the previous one here. I'd have to kind of walk through it real quick and figure out what the entry would be. But we'll, hopefully you get what's going on here. I apologize for the math error. All right, so the last point of comparison, instead of doing either individuals or groups, you're just doing the inventory as a total. So we're just comparing these two numbers, and we're just carrying over the lower of the cost or the net realizable value. In this case, the cost is the lower, right? So, and so what we have there in that situation is there is no difference, so there's no journal entry. There's no write down that would be necessary. All right, well, hopefully that wasn't too bad. And I'm gonna hopefully we'll pick up with lower of cost or market. Hopefully that comes out in about a week. But until then, hopefully this was helpful.